Hello AP Econ students, this is Ms. Haley and welcome back to AP Macro Flip videos. Today we're going to talk about money and the Federal Reserve. So what is money? So the most common use of currency that you all probably see in your day-to-day life physically is bills and coins that we use to buy goods and services. So how did nations begin to rely on bills and coins, and what were other ways that we began to use money as a medium of exchange? So medium of exchange, right, we're saying that we're using money to trade for goods and services. So if we want to buy something that's food or clothes or shelter, that we're using money to gain it. So earlier historical examples of medium of exchange, we see bartering. So if you're in ancient Egypt and I have papyrus, the guy over there is cedar wood, we exchange equally our items. That I want that cedar wood, he wants my papyrus, and so there's a double coincidence of wants. But with different goods and different services, there isn't always a double coincidence of wants. And so over time, different types of money emerged. So commodity money is when we have specific items, these specific commodities, they might be arrowheads, they might be cows, they might be pieces of gold, are used to actually buy goods. But commodities are sometimes difficult to lug around. Think a cow. You can't just always take a cow to a supermarket. And so over time, societies also created commodity-backed money. So we have a representation of the commodity, which in the case of the gold standard US, we represented the certain amount of ounces of gold with this paper currency. And then over time, even the US phased out the gold standard, and currently all countries have fiat money. So we have this physical paper of money, and that paper isn't backed up by gold, isn't backed up by a cow, it's just paper that is backed up by the declared legal tenderness by the state and by other countries who do trade with that country and with that currency. And so in addition to money being a medium of exchange, money is also a unit of account. And so a way for me to look at a Nintendo Switch and say it's worth 60 JDs and someone else to understand that common currency language. Money is also used as a store of value. Not as commonly now, but it used to be someone saying, I am a billionaire, I'm going to hold on to and store that amount of wealth by taking $1 billion and putting it in my mattress. But as we're going to see when we talk about banks and how one can incur interest by having deposits in a bank, that actually holding on to money without putting it into the whole monetary system isn't actually maintaining or growing your wealth. And so now that we know what money is and what it's slightly evolved into, we're going to talk about two different quantities of money, M1 and M2. So M1 has to do with currency, so that paper and coin currency, M0, but also checkable deposits, which checkable deposits, right, if I have a checking account and I've deposited money into that checking account, the way that I can pull out money is writing a check and then giving it to a business. So that check is my promise saying, hello business that I'm buying this good or service from, I'm promising you that I have 100 JDs in my Arab Bank checking account, and if I withdraw that money for you from represented by this check, you will be able to access that amount. And so when we move from M1 to M2, the actual deposits become less liquid or less accessible. And so if we're looking at M2, we're looking at saving deposit, we're looking at money market mutual funds, which we'll talk about a little more later, or CDs. If I'm putting money into a CD, which I did right before I came to Jordan, that money with a specific CD that I bought had to be in the bank for 5 years, that I couldn't touch any of that money for a long extended amount of time. So I'm incurring more interest, but then the bank also is able to hold on to the money. And then as we're going to see in a second, they're allowed to trade or to give out loans with that money. And so if we take everything in M1 with everything in M2, we have what's called the total US money supply, or the total money supply of any country. And we're going to see why the Fed would want to actually issue that number, that supply, and how they can play with that amount of money supply that's in the economy. And so why do we even care about the money supply? What you all might remember, we're going to quickly review this. In the quantity theory of money, there's this connection that if we have an increase in money supply, there's also an increase in price levels all across the economy. So if the Fed or if banks are increasing or decreasing the money supply, it can influence the price levels and influence the GDP of a nation. So this is part 2. How do banks create money? So banks, which you all might remember from our loanable funds market, they are giving out loans that individuals or firms demand, and those loans have a price of an interest rate. But banks are also receiving the supply of loanable funds, so people who are depositing their money into the bank. So we see banks, whether they're giving out loans or they're receiving deposits, are this intermediary middleman. And the way that the banks can make a profit in their middleman position is just like any profit if their costs are lower than their revenue. And in this case, revenue for banks are the interest on the loans. So after they give out this loan, they're getting money back for selling that loan. So if the interests are higher on the loans than the interest rate that the banks have to give out for the deposits, right? Banks need to incentivize people to give them money instead of people just saying, I'm going to keep this money in my mattress or under my floorboards. If the bank is saying, you have this percentage of the money you're going to get back each year as an interest rate on your deposit, then people will actually want to put money in the bank. But as a good businessman, the banks want to be keeping a higher interest on their loans than on their deposits. And so we want to look at the bank's banking sheet, the balance sheet of a bank, to see how much the bank has in assets or in items that the bank owns themselves, and liabilities, so items that the bank is financially obligated to owe to other people. And the owner's equity is looking at how much you have in your assets, which in this bank is $800, and then subtracting the deposits, the borrowing, which takes up all the liabilities. So this individual bank has an owner's equity of $100. And then from the assets, you probably see, hey, what are these reserves? It's not Army reserves, but similar idea that you always want to have on file a certain amount of money, and how much money or what percentage of total deposits that a bank needs to have on reserve is actually regulated by the central bank. So bank reserves. The reason why we care about how much a bank needs to keep on reserves is because this concept of fractional reserve banking. So in class, we're going to do a simulation about fractional reserve banking, and it shows that from banks getting deposits from depositors, from individuals, from firms, banks are required to keep some of that money on hand so then people can take that money out. But banks also, again, we remember that they want to be incurring more interest from loans than the interest on deposits. So banks want to be loaning out a ton of money to then be making some sort of profit. Why are banks required to hold a fraction of their reserves? Well, if you all are students of history and knew about the Great Depression when there was runs on the bank, which means that people wanted all of their deposits back, but they could only get some or maybe not even any of their money back, and people lost faith in the bank. Banks need to have a certain amount of money on reserve so then their depositors can actually access their funds. So the required reserve ratio is the specific portion of deposits that the banks are required to keep on reserve. So in this instance, in the US, if banks have to keep 10% of their money on reserve, on the deposits on reserve, then the banks can take the 90% of the deposits and use them as loans. And then banks aren't always loaning out all that 90%. So anything that is more than 10% of reserves is excess. So how do banks create money? Again, we said that banks are the intermediaries between the depositors and people who want to gain loans. And so banks create money by taking money deposited into the banking system and then saving some of it with a required ratio and then loaning out the rest. And so if the bank is giving out loans, those loans then become future deposits. And so as loans become more and more deposits, we see an increase of overall money supply. And the way that we can calculate, similarly to how we calculated the money multiplier in fiscal policy, the simple money multiplier in monetary policy is 1 divided by the reserve ratio. So let's look at how this would work. So if I'm a King's teacher and I have $1,000 that I received from my January salary, and so I'm going to put all of that money into my bank account. Obviously, that's not what is happening in real life, but let's just, for this simple example, say that. So I put all the $1,000 into my Arab bank account. And so if the Arab bank account has to keep at least 10% of that money on hand for me to access at any time, they're going to take that 90% and loan it out to someone else. And so now I still have that $1,000. I want to be able to access that, but 90% of my deposit then becomes someone else's loan and then a future deposit. And so each round we see that there is a fraction of that new deposit given out as a loan and becoming a new deposit. And if you take the sum of all of these at the very end, we see that the total amount of money in circulation from this first deposit is now 10 times more, because the money multiplier, again, is 1 divided by the reserve ratio, so 10. So we see how banks almost magically can create a larger money supply, but that isn't unregulated. So how does the Federal Reserve, or a central bank, control the money supply of a country? So the Federal Reserve is a specific name for the U.S. central bank, but all central banks have this pressure or responsibility to give deposits or extend loans to other banks. These central banks also are in charge of the monetary policy of a country and also the bank regulation. So making sure that banks are stable and either increasing or decreasing reserve requirements to lead to more stability. And so, as we discussed before, banks are this middleman between people who are depositing money and people who are loaning money. And that's not just in the sense of banks loaning to households and firms and households and firms depositing in a bank, but it's also in the sense that banks sometimes need to deposit with each other and then loan to each other. And so that's the overall idea that we want to understand, but specifically here we have certain terminology for if there's loans, but interbank loans, so banks are loaning to each other, that they'd be called federal fund loans, and then the price paid on that type of loan is a federal funds rate. But then even more specifically, the loans from the Fed to the private banks is called a discount loan, and that the price of this loan is a discount rate. So it's still the same idea of as banks being an intermediary, but now we're just talking about when banks are actually in this process with each other. And then we're going to go into even more depth about this next week. But when the Fed wants to actually have monetary policy influence the state of a country, if we're in a recession or if we're in inflationary periods, there's changes that the Fed can take to either increase or decrease the amount of money. And so if the Fed says we want to increase the amount of money in circulation, they can be buying treasury bonds. And so by the financial institutions selling a bond to the Fed is then putting more money into circulation. The opposite of that, if the Fed is saying we actually want to decrease the quantity of money in circulation, they would actually be selling bonds back to these financial institutions. And so another way that banks can alter or change the money supply is going back to that idea that banks can lend out a certain amount of money, but then have to keep a certain amount of money on hand, a certain amount of deposits on hand as these required reserves. And so what the Fed can control is how much is on these required reserves. And so if the required reserve increases, then we see a decrease in the money multiplier from monetary policy. Whereas the opposite, if banks don't have to keep as much money on hand and they can actually spend more or give out more in loans, then there will be an increase in the money multiplier, an increase in the supply of money. So thank you all for tuning in today's video, and I am looking forward to seeing you all soon.